Alright folks, welcome back. This is the weekend commentary for the IC2 Mentorship. This is our daily chart on the dollar index, and if you recall on Wednesday's midweek review, I mentioned that we would likely drive price up into the volume imbalance here, and once it got there, it would be critical to see what it does after. I mentioned how it could very easily just trade there and start making an attempt to run for this old low. That's essentially what we started on Friday, but we stopped right after trading into the bullish order block and closing in this imbalance right here. So we have a buy side imbalance, sell side inefficiency, and also we traded down into all of this again. So it's been re-delivered. So what does that mean? It means that it has to, it has to overtake this low now. If it fails to take this candle's low out, all we've done is just retrace back down into rebalance, and any movement back above the volume imbalance, that is bullish. So in other words, if we start to trade back above this high right here, there's no reason for it to trade back up to this volume imbalance again from where we are right now. Okay, so it's important you take a screenshot of this chart, and I'll move my cursor out of the way so you can get it again. This return here, even though we're in a bearish market, it does not bode well for continued bearishness if we trade back above this short-term high. So if that's the case and we do trade back above there, and I'm not saying that we are, I'm just making a case for if this market changes gears this week and goes back above this short-term high, the buy side liquidity resting above these relative equal highs, and the fair value gap there will most likely be the next draw on liquidity. As it is right now, should we trade lower than this low, the sell side liquidity here and the sell side liquidity below that low here is where I think it's going to go. That's the side of the marketplace I'm siding with. That's what I think is likely to occur. But what changes that, because we only talk on Wednesday and on the weekend over live charts, not that this is a live chart, obviously we're looking at it, it's Sunday morning. I did this late this weekend. I had a lot of family functions that prevented me from doing it earlier. But the high, if we trade above that, that sends everything bullish to this area here and then there. Otherwise we're bearish. All right, you can see how the market traded up into the volume imbalance on the 13th. So Thursday's trading, we traded up into it. Volume imbalance, break here, trade right back up in, break one more time lower, disregard this tail. That's only a stop hunt. So we're looking for the price to likely trade down below this short-term low. That's what we're anticipating, that's what we're looking for. Now, I mentioned how this could have very well become a market maker buy model. I mentioned that on the midweek review. This still is one of the characteristics of a market maker buy model, where it goes up into the optimal trade entry of the parent price swing, which is actually prior to this over here. But it can enter a level of distribution where this becomes, where this is a market maker buy model, the low to where it could become a failure to take out the original consolidation, which is again over here. Look at Wednesday's video again. This is an area of distribution where it becomes a market maker sell model. So we're targeting the sell side liquidity resting below here. So within a larger market maker buy model, where it could fail, which is what I taught and teach in market maker models, this could be the turning point that says I don't need to go above the original consolidation to take the buy stops. I'm going to go just to this point here and then enter a level of distribution and then resume with the higher time frame trend. When you see that, you go right back into thinking, okay, consolidation, leave, come back into the consolidation, smart money reversal, low risk sell, distribution, another level of distribution, and we're targeting the sell side liquidity here. So within a larger buy model, there is a sell model. Dollar 15-minute time frame. Okay, you can see on Friday's trading, midnight, small little retracement, and then breaks hard, comes back up in, breaks lower again. Notice that we do not go back up into this short-term low as classic market structure, as you witnessed me correcting some ill-informed educators about market structure. It's not all about market structure, okay? And I introduced to the public the differences between classic market structure and institutional market structure. There's no return back to this low as a support broken term resistance. It doesn't happen. See, it fails here. It doesn't even get up there. But when we look for ideas like fair value gaps, institutional order flow entry drills, where this candle is just taken out by 1/10 of a pip right here, just trades right up into that, and then displacement. Small little fair value gap in here, trades up into that, then displacement. Okay, they're looking for the low broken here, traded back up to there, and that's fine. But would you rather have that entry or that entry? That's the differentiation between retail-minded classic support resistance and break and retest and institutional order flow. There's no comparison. So we do have sell-side liquidity pulled up underneath of here and under here as well. So all of this may have been just a pump up and then attacking that longer term daily low as we were outlining for months now. All right, euro dollar, this is our daily chart. I mentioned that we have an order block in here. This could act as some potential accumulation for longs. We traded down into that on Thursday at the same time that the volume imbalance. Now listen folks, the same time that the dollar hit that daily volume imbalance, the euro hit the bullish order block there. We had a small little imbalance here. It traded through that and above. So I like the idea of it getting back above here, the buy side liquidity. We have optimal trade entry as well. And nothing in here says we've reversed. This gap, which is the wick of this candle, consequent encouragement is next after this high is taken, if it gets there, and then this high here. And if we do see a complete breakdown of the dollar index, we'll be looking for this high to be taken out eventually. Euro dollar, again, this is that daily bullish order block. Trades down into it. Optimal trade entry. Rallies. All of this in here is irrelevant to me. I'm looking at these highs here. So I'm not looking at just popping above here and then collapsing. I'm looking at, we're likely to draw up into that 120, 185, 122 big figure. Lots of liquidity there. 15-minute time frame euro dollar. Again, midnight on Friday. Initial run closes in all the sell side imbalance, buy side inefficiency that you've seen on your daily log entries. Real quick, let me enter this because if I don't say it now, I'm probably going to forget about it. I got an email from a student asking, what are we supposed to be doing with these PDFs? And he mentioned he didn't really know what it is he's supposed to do with them. What's the point? What's the value? What's the purpose of the daily log entries? Well, if you are seeing the things I'm annotating in the charts for those PDFs, those things must be in your chart. Okay, those are the things I'm looking at. That's where my attention is at the time, looking at those respective time frames. And since we just do the 15-minute time frame, those PD arrays, those annotations are the things that I think are most important right now. And then you study how price goes forward around those levels, how it's respected, how it disrespects it. That's how you're gaining the experience, and I'm lending my experience to you. It does not always translate to I'm setting up a pattern or a framework for you to take a trade. And that's what many of the 2021 students are trying to squeeze out of me and arm wrestle me. Like, can you turn this into a signal service? Can you turn this into an advisory service? It's not. You don't need that, because if you do this for months, carry the annotations that I'm sharing from the PDFs into your own charts, you will see that the markets are most of the time trading to these levels or respecting them, and they're salient to right now, not old hindsight stuff where I can talk about it and bore you to death. I'm giving you the nuts and bolts of what you should be focusing on right now on the hard right edge, much like I do when I do these weekend commentaries and in the midweek review, where I'm talking over the chart at the time, which is what, again, most of the 2021 students want me to go back to on a daily basis. And it's too much work to do those types of videos every single day. It's a lot. It's a lot more efficient for me to make PDFs, and a lot of your lessons are going to be done by PDF. So you might as well just get used to that, because we're going to be doing the midweek and weekend commentaries, yes, and then charter video once a month. But you're going to get a lot of lessons that are PDF, because it's much more efficient for me to deliver the content. Plus, it gives you annotations and chart notes, if you will, that are already done for you. So that way, anything you want to revisit, or if I go in the future, like a year from now, and I say, look, review the lessons I did on this here. That way, if your note-taking skills aren't strong, or you're just not really hungry about recording every little observation, the things that I'm going to teach in the PDF lessons will more or less ensure that the things that you should have either gleaned from the lesson or understood will be in that lesson. Okay, so anyway, I just want to interject that here, because I had it in my notes and I didn't mention it the last time we were talking on Wednesday. The student knows who he is. All right, so anyway, buy side liquidity pool is in here, obviously, and we'll be looking to see if we get that continuation lower on the dollar and then higher on euro. All right, British pound. This is a daily chart. I mentioned a little bit about all this here on my YouTube channel. We do have a buy side and balance, sell side efficiency that did get rebalanced here on Thursday at the same time, okay, the same time that the dollar index hit its daily volume imbalance. So that's the balancing act you have to do as a trader. Some of you, if not most of you, come into trading wanting to have, I just want to look at one market. I want to be able to just look at that one market, that one chart, and have everything understood. And that is too myopic. Can you win doing that? Yes. Will you lose a lot? Yes. You'll probably lose more than you win, because you're going to see things in a chart. If it's one market, no intermarket relationships, no intra-market relationships, no cross-referencing a benchmark like the dollar. You have to have these things, folks. And that's what makes this difficult, because it's not just a one chart, everything, and there it is. You have to glean things from different time frames, different asset classes, to help build your intermarket relationships, where if you know that the dollar is likely to go down because it hits a volume imbalance on its daily chart, at the same time that the British pound's hitting a closure of a buy side imbalance, sell side inefficiency. So all this imbalance has been rebalanced at that point right there. So when that occurs, and you are also seeing the daily, which is what I drew your attention to on Wednesday, that's a critical. Go back and listen to the video, and many of you are recording them or downloading them and keeping them in your own computer, okay, where I can't go in and change it. There's no editing. I mentioned that's critical. It's critical because if that volume imbalance gets traded to, it could turn dollar lower at that point, and that would set the stage for this buy side imbalance, sell side inefficiency being rebalanced, and then allow price to trade higher. Now, at the time of this trading to that closure of the buy side imbalance, sell side inefficiency, once it hits that, what was left from this high to that low, we have a small little sell side imbalance, buy side inefficiency in the form of a fair value gap. So this small little portion of price action did in fact get rebalanced on Friday. That's that level here. It trades up into it here. Now again, disregard that wick and focus on this area up here, because I think that's the buy side liquidity that's going to be most likely drawn on, unless we take out this low here. So as long as we're above these equal or relative equal lows here, then we're bullish. All right, on the 15-minute time frame, you can see we have a small little Judas swing here, dropping below the opening price there. Rallies, comes back in, rallies again. Really muddy. What I mean by that is this real sloppy back and forth price action. It just keeps grinding higher and higher. Anytime anybody wants to go short, they just keep taking them out. But usually when you see stuff like that in price action, it usually sets up a nice sell-off. I don't personally see that here. I think they're going to run the high, as I mentioned on the hourly chart. So be mindful that we may see a run on sell side liquidity, but the low I mentioned on the hourly chart, if it's kept intact, we remain bullish on pound. All right, on Wednesday's video, again, you should have this in your notes. I mentioned that you should go into your chart on the E-mini S&P and look for the nearest volume imbalance below price. Okay, and you can find that on the daily chart. That's what this is here. This is the premium high of the volume imbalance on the daily chart. This is the discount low of the volume imbalance on the daily chart. The market trades down to it on Thursday, hits it. Now, I'm not sure where you're from, but this is extremely convincing that this logic works. But for those that are still skeptical, I'm going to go into a little bit more detail with it. This also is a volume imbalance on the daily chart too, but it's also right on this up close candle, which is a bearish order block with a fair value gap and a buy side liquidity pool. So it trades to that after trading back down into consequent encroachment of a 15-minute fair value gap that was part of this buy side imbalance, sell side inefficiency on the hourly chart. I'll take you through the whole thing, but for now, just take a look at the sensitivity of there to there. Now, if we look at that 15-minute time frame, you can see the buy side imbalance, sell side inefficiency, and then consequent encroachment, midpoint of that gap. This is the premium high of the daily volume imbalance on the E-mini S&P June 2021 contract. This is the daily chart, and here is that volume imbalance. This was Wednesday's trading, and the time I was doing the recording, this candle hadn't formed yet. I said, your homework is to note the nearest volume imbalance. This is your volume imbalance. There's no candle bodies in between these two opening and close. Opening and close. This candle's body to this candle's body. There has not been any body of another candle later on yet, and still hasn't. But the sensitivity there hits it, bang, and then runs to this volume imbalance and through this volume imbalance. So this whole price run here is what I had you studying. Now, what's important is now that we traded up into this volume imbalance, I want to see, does the market have an inability to get above this volume imbalance? Because if it does not trade through this week, stocks are going lower, 3,500, maybe 3,250. That we could see that as a correction on E-mini S&P. But if we trade above this volume imbalance, then that's really bullish. Let's take a deeper look into what was going on as the market trades down into the daily volume imbalance. And I have, if you've already noticed already, the Dow is the orange, the NASDAQ is the light blue, and the darker blue is the E-mini S&P. So this lighter blue line here, that's the NASDAQ futures index. This is the E-mini S&P futures index, and the Dow orange. That's the Dow futures contract. The market hits the volume imbalance on the daily chart, then rallies, breaks market structure. And we'll look at charts show better detail of this in a moment. But for now, just look at the overlap and relationship between the three averages. We traded down into that 15-minute time frame, buy side imbalance, sell side inefficiency, consequent encroachment, then it rallies. Study that low comparably to each index and see if you see anything. Pause the video and study before I go any further. All right, if you haven't paused the video, I'm going to ruin the opportunity for you to discover it on your own. We have this little low to this low. Notice that the Nasdaq's low here is broken by this lower low. The Dow's low here is relating to that low. The S&P darker blue line's low here is relating to that. So we have that index divergence. That is accumulation. That's how you really see accumulation, after it hits a discount array and a break in market structure. So this is the pattern that will always occur when you're trading index futures. It's always there. It's going to always work. It's always going to be there all the time, 100% of the time. It's never going to fail to appear. It's there, but you have to have the narrative and understanding why it should form. And when you see that, then you can anticipate the accumulation of longs by smart money, and then the distribution of that price higher, reaching up into that daily volume imbalance. But because we're plotting this line all on a line basis of the low of each candle, so if you go into each one of these individual indices and you click on the settings and you plot the line on the low, what you're doing is you're measuring and comparing the contrast between the delivery of price for each respective indice with their low price. Because if we're looking for a low to measure buying or accumulation of longs, you're going to be plotting it on the low. If this was reversed and we were looking for distribution or accumulation of shorts, we would be plotting the line on the high. Okay, so let's move on into the comparison between the E-mini S&P versus the Nasdaq. You can clearly see the divergence here. Low to low for S&P, higher. Low to lower low on Nasdaq. That right there is what your eye should be keyed up on. That's the divergence. That's the Kraken correlation. Now the Dow and the S&P pretty much moved in tandem, which is what you would expect in a perfect symmetrical market. But the Nasdaq was that Kraken correlation that told you that this returned back to consequent encroachment on the S&P. That's a time to be a buyer, because you have now SMT divergence across the three major averages. Now, from a visual representation with candlesticks, keeping the fair value gap on the 15-minute time frame in reference to where that is in the S&P versus what the actual Nasdaq futures was doing at the same time. Nasdaq futures had its own buy side imbalance, sell side inefficiency down here. So its consequent encroachments here, draw that out in time, it hits that. But in the process of doing it, notice what has happened. Its low here has been violated. So it needed to go lower to go into its own buy side imbalance, sell side inefficiency, and consequent encroachment. The rally from this low, notice that if you look at it from the perspective of the Dow futures, we have the low and an unwillingness to get back down even into its own buy side imbalance here. So it was really reluctant to go any lower. Whereas we see the S&P rallies, comes back down into consequent encroachment there. At the same time, once this break in market structure occurs there, this imbalance becomes the area where you wait for a trade idea to form. And then watching how the averages, when we get into this, do the averages respect that decline equally? In other words, are they all making lower lows? As you can see, we only saw the Nasdaq make a lower low, whereas the Dow and S&P made higher lows respectively. And as a result, you can see that the market did in fact trade a pretty good number of handles up into its volume imbalance on the daily chart. Now, as a swing trader, if you look for setups like this using your daily chart and then framing it out from a liquidity standpoint and imbalance, that's using institutional market structure. You're not just looking at support and resistance. You're not looking at order blocks by themselves. You're looking at how the market's going to move from one level of accumulation of either longs or shorts to a level of distribution. So you're measuring the real underpinnings of the marketplace. Now, don't think that this is only useful for trading indices, okay? Because some of you are totally against the idea of ever trading the S&P, the NASDAQ futures, or the Dow futures, and that's fine. But the same thing occurs with currencies. The same element that's being shown here in comparing and contrasting and looking at order flow is seen with the dollar, the euro, and the cable. It's just you have to reverse the idea of the dollar index. In other words, you're going to invert that, or just remember that everything you're looking at with the dollar index is reversed. So it causes a little bit of confusion. This is what most of my early students got confused with when I started teaching SMT. They forget that whenever you overlay something on euro and cable and you're applying an overlay of the dollar index price action, so that way you're looking at the overlay of three currencies: US dollar, euro, and cable or British pound. The dollar index is going to be going opposite to that of euro and cable. So it's not going to always be as easy to spot like it is when you have all three of them, which usually move in tandem, and then the one that doesn't do what the other two are doing, that shows the cracking correlation, as I just displayed here. This is not a new concept to you. You all have seen me do this even this year in a couple weeks commentary. I went through and showed you how to look at the S&P and how we were looking at moves that ended up unfolding as well. This one here, I tipped you off the day before and told you watch that volume imbalance. And then once it hits it, it runs through the short-term high. That's a break in market structure. Then once that occurs, you strip all this price move down. Where are the discount arrays? Well, you have the closure of the buy side imbalance, sell side efficiency from here. Then the midpoint, which is consequent encroachment there. And now the question in your mind is how do you know it's not going to go down here and close it in? Well, remember in your notes, I'm telling you that we don't want to see that closure. Okay? I'm not Chris Laurie teaching you voids and closing in voids. I'm teaching you institutional order flow. Okay? I'm teaching you the real mechanics. You don't want to see this imbalance completely closed in. That's beneficial for you. So if you don't want that to occur, that means you're going to key up on the midpoint, but allow for your stop loss in the event that it does completely close in. Why is it beneficial? Why do we want it to keep a small portion of it open and not closed in? Because that's going to be indicative of a breakaway gap. This shows an unwillingness to want to come back down and close this all the way in. It only stops halfway, which is here. That's a signature that I'm training you and teaching you to look for, to welcome in your analysis, but also have it in mind when you're putting your stop loss on for your trade. Don't think that I'm going to buy the consequent encroachment and I can put my stop loss rate below the imbalance being closed in. No, you don't want to do that. You want to have that fact that you may be buying in here, but it might completely close in a little bit and maybe go 1 or 2 pips beyond it, trade into the order block. That's reasonable. That's permissible. And you have to make concession for that in your analysis and in your trade. But most of the time, you're going to see if you really are in a market that's strong and bullish, it's not going to close in all the time. And that's, if I could sit down with Chris Laurie and tell him, some of the things that would improve the way he trades or teaches, but that's like give him gold and then he would have it in his course. But that's the distinction between he and I when it comes to things like this, because if I draw attention to this and make reference to it, I'm accused of copying Chris Laurie. When I was doing this stuff before Chris Laurie ever even started teaching, I was doing it way before, way before. So, and again, the logic that I'm teaching is completely different, and I'm teaching the characteristics of why this is important to leave a small portion open versus completely closing in. It's very similar to what you see here. So you have this imbalance there, buy side imbalance, sell side inefficiency. Same thing occurs here. Notice it, from this low to that high, we have the imbalance and consequent encroachments here. Notice it didn't even get down to that. And look at the reaction right on up. So it completely defies what has been made common knowledge now with liquidity voids, which nobody invented liquidity voids. Okay, that's a term that's been tossed around. Chris Lori didn't coin that term. It wasn't originated with him. He learned from a price action trader that doesn't even have a significant following, and he never even mentions him when I asked him. So all these things are just price vacuums. And whenever you see things like this on the chart, where all this really started from, I'm going to give you a history lesson here, okay? This whole idea of a liquidity void, or as I define it, as a buy-side imbalance, sell-side inefficiency, that's exactly what it is. That is the terminology that's used from interbank level traders, and it originates from the idea of a price vacuum. Now, what is a price vacuum? Price vacuum is when price is delivered on a very sudden basis, one-sided, and you get a big range like that. It has nothing to do with engulfing candles, okay? That is the biggest misconception that everybody in quote-unquote smart money teaching is doing right now. They're trying to say, oh, it's the engulfing candle. That's not. It has nothing to do with anything. The price vacuum is where it's all buying in an absence of the opportunity to sell short at a favorable price. Like, even though the market's going up like this is the disconnect you're having right now. Why would anybody want to go short or sell when you have a big candle like that? Because not all of the volume in the markets is trading. It's commerce. Most of it is commerce. You don't want to hear that. You want to think that it's all trading, it's buying and selling pressure, but that's not what it is. Most of it's commerce. So because it's an inefficiency where the market doesn't allow the participants for the sell side of exchange, because that's what we're dealing with, foreign exchange. Okay, it's not foreign trading. It's not foreign trading. Okay, it's foreign exchange. So the idea of exchanging one currency for another, that's the real benefit and purpose of having this market at all. Now, when there is an imbalance like this, it creates what is referred to by the old timers in the open outcry pits. Before I was even born, okay, they always looked at their charts and they noted this as a price vacuum. That was inefficient. They know that the likelihood of the market wanting to eventually get back down in here, they would have their orders in here on a piece of paper, on like a little notepad, and they kept that in their pocket, and they had their, well, we know it as pivot trader numbers, like or pivot numbers, which was taking the open, high, low, and close and doing math with it to get the R1 level, R2 level, R3 level, or S1 level, S2 level, S3 level, just pivot points. And those levels would be monitored by the floor traders. Because they're on the floor, they had their numbers on their pad. There was no charts in their hands. They had their notes and levels they wanted to watch. And when we entered into areas like this, they anticipated digging into that to maybe accumulate new long positions. That's a price vacuum. I did not create a price vacuum. I am not the author of a price vacuum. What I'm teaching is the element that makes this a buy-side imbalance, sell-side inefficiency, and this a sell-side imbalance, buy-side inefficiency. There's a distinction between looking for a void or an imbalance to be completely closed in and not wanting to see it close in. There's times when you don't want it to. When is it that you don't want to see it completely close in? Like this, where we have a level I announced to you before it happened, trades to it, then we get a reaction. We have a break in market structure. This imbalance here, we don't really want to see it completely come back down and trade into that, because that's classic market structure. That's a resistance level, broken, turn support. I don't subscribe to that, folks. Like I mentioned on my YouTube channel the other day, and you hear me basically beat you up with it all the time, because even though I have a lot of students here, I still have students that think that I use support resistance theory, and it's like I'm literally tearing it to shreds every time I get in here and talk to you. That's not what I'm doing. I draw strong distinctions and contrast to that idea, which is retail, and what it is that I teach you, and what works, and what causes these markets to be having these gyrations to these what would otherwise be completely random levels. So that's going to be it for this one. I will touch base with you obviously on Monday with the daily PDF, and I'm going to most likely have a YouTube video up tonight by 10 o'clock my time. Until I talk to you then, enjoy the rest of your weekend and be safe.